Welcome back to the CMA USA Exam Coach. I'm glad to have you here once again as we continue our journey through the world of corporate finance. In our last episode, we discussed bonds, a classic form of long-term debt financing used by corporations. We looked at how companies issue bonds to raise funds while promising to repay the principal, along with interest to investors over time. Now, in this new episode, we shift our focus to a different type of long-term financing, one that sits between debt and equity in terms of risk and return. Yes, we're talking about preference shares, also known as preferred stock in some countries. Preference shares are a hybrid financial instrument, meaning they have features of both equity and debt. They represent ownership in a company, like common shares, but with some unique characteristics that set them apart. When a company issues preference shares, it is raising long-term capital from investors. But instead of paying fixed interest like on bonds, it pays dividends, often at a fixed rate. And unlike bonds, these dividends are not a legal obligation, but they are typically paid before any dividends are given to common shareholders. Preference shares are especially attractive to investors who seek regular income with relatively lower risk than common shares, and to companies who want to raise funds without increasing their debt burden or diluting too much control through common equity. So in this episode, we'll explore what exactly preference shares are, the key features that make them unique, the types of preference shares, and how they compare to both bonds and common equity. By the end of this session, you'll have a clear understanding of how preference shares work and where they fit in the corporate financing structure. So let's get started. As we move on to this slide, let's understand how bonds, preference shares, and equity are positioned and treated within a company's financial structure. As you can see on the slide, bonds are listed under the long-term liabilities section of the balance sheet. This means they are considered a debt obligation that the company must repay over time. When it comes to bondholders, the company is required to make fixed coupon payments, which occur after the company reports its operating profit. These coupon payments are deducted from the operating profit before we calculate the taxable income. So, as we discussed in the bond episode, the coupon payments on bonds are considered a tax shield because they reduce the company's taxable income. Now let's shift our focus to preference shares. In contrast to bonds, preference shares appear in the equity section of the balance sheet alongside common shares. This means they represent a form of ownership, although with different rights. Holders of preference shares receive periodic dividend payments, which are usually fixed and paid before any dividends are declared for common shareholders. However, it's important to note that preference shareholders are not considered true equity owners in the same way that common shareholders are. They typically do not have voting rights or control over corporate decisions. In the next slide, we will compare bonds, preference shares, and common shares side by side to clearly understand the similarities and differences across these three major forms of corporate financing. Now let's take a closer look at how bonds and preference shares are similar and how they differ. Understanding these points is important because both instruments are used by companies to raise long-term capital, yet they function in quite different ways. Let's begin with the similarities. Both bonds and preference shares offer fixed payments to investors. In the case of bonds, it's a fixed interest payment, commonly referred to as the coupon. For preference shares, it's a fixed dividend paid periodically. Second, both instruments rank higher than common equity when it comes to claims on the company's assets. This means that in case of liquidation, bondholders and preference shareholders get paid before common shareholders. Third, both bonds and preference shares are widely used as long-term financing tools. Companies use them to raise funds that are not required to be repaid in the short term. Next, both are tradable financial instruments. Bonds can be bought and sold in bond markets, while preference shares are often traded on stock exchanges, depending on the type. Also, neither bondholders nor preference shareholders usually have voting rights in the company. That means they do not influence corporate decisions in the way that common shareholders can. And finally, both instruments offer a form of steady, periodic income to the investor. This makes them attractive for investors looking for regular returns. Now that we've covered the similarities, let's look at how bonds and preference shares differ. First, on the balance sheet, bonds appear under long-term liabilities because they represent debt the company owes to bondholders. In contrast, preference shares are shown under the equity section along with common shares. Second, the type of payment differs. bondholders receive interest, and this interest is usually tax-deductible for the company. On the other hand, preference shareholders receive dividends, which are not tax-deductible. This makes interest payments more favorable from a tax perspective. Third, there's a major difference in payment obligation. A company is legally required to pay interest to bondholders. Failing to do so may lead to default. However, dividends on preference shares are not a legal obligation. A company can choose to skip them, especially in tough financial times. Fourth, bonds come with a maturity date, meaning the principal amount must be repaid at the end of the term. Preference shares generally do not have a maturity date, and companies are not obligated to repay the capital unless they are redeemable preference shares. Fifth, in terms of ownership, bondholders are creditors of the company. They lend money and expect it to be repaid with interest. In contrast, preference shareholders are quasi-owners. They hold equity, but without the full rights that common shareholders enjoy. And finally, let's talk about risk. Bonds carry a lower risk because of fixed payments, priority in repayment, and legal protections. Preference shares carry moderate risk. They are riskier than bonds, but safer than common shares since they receive dividends first and rank higher in the capital structure. So as you can see, while bonds and preference shares have several things in common, they are fundamentally different in terms of risk, legal status, and financial treatment. Now that we've understood the comparison between bonds and preference shares, let's move ahead and examine how preference shares compare with common shares, the most well-known form of equity. Let's begin with the similarities between preference shares and common shares. Both are reported under the equity section of the balance sheet. This means that holders of preference shares, like common shareholders, are considered equity investors in the company. Second, both represent a form of ownership. While preference shareholders may not have the same rights as common shareholders, they are still owners of the company. Next, both are issued by companies to raise capital. Corporations use both types of shares as a means to attract investors and fund long-term operations or expansion. Also, both preference and common shares can be listed on stock exchanges and traded in secondary markets, making them accessible to public investors. Lastly, both types of shareholders can receive dividends. Preference shareholders typically have a fixed dividend, while common shareholders may receive variable dividends depending on the company's performance and board decisions. Now, let's look at the differences between preference shares and common shares. The most notable difference is in dividend priority. Preference shareholders are paid before any dividends are distributed to common shareholders. If the company has limited profits, only preference shareholders may be paid. When it comes to voting rights, preference shareholders typically do not have voting power, whereas common shareholders enjoy full voting rights, including the right to elect the board of directors and approve major decisions. In terms of dividend guarantee, preference shares usually have a fixed dividend, although it's not legally guaranteed. Common shareholders, on the other hand, receive no fixed dividend. It depends entirely on the company's discretion and profitability. Another key difference is the claim on assets. In the event of liquidation, preference shareholders have a higher claim on the company's assets than common shareholders, who are paid last, only after all debts and other claims are settled. Price behavior is different as well. Preference shares tend to be more stable, offering predictable income. In contrast, common shares are more volatile, with greater exposure to market fluctuations and economic performance. When we talk about capital appreciation, preference shares typically offer limited growth potential, since their price remains relatively stable. Common shares, however, offer high potential for capital gains, especially in growth-oriented companies. And finally, in terms of control and influence, preference shareholders usually have no role in decision-making. Common shareholders, due to their voting rights, can influence company policies and leadership. So, while both preference shares and common shares fall under equity and share some features, they serve very different purposes for both the investor and the company. All right, class earlier, we learned how to calculate the selling price of a bond. Remember, bonds pay fixed interest over a set number of years and then repay the face value at maturity. That fixed time period is crucial because it lets us calculate the present value of all the future payments, both the interest and the principal. But now, let's look at something a bit different: preference shares. Unlike bonds, most preference shares do not have a maturity date. That means there is no point in the future when the company is expected to pay back the original amount invested. So, if you invest in a preference share, you're not expecting a lump sum return at the end. Instead, you're receiving a fixed dividend, usually every year, and you'll keep receiving that dividend forever, or at least as long as you hold the share and the company continues to operate. This is a big difference. Because there's no maturity date, we can't treat preference shares like bonds. We can't use the regular present value of an annuity formula because that only works when the cash flows stop after a certain number of years. So what do? Well, since the dividend continues indefinitely, we treat this as a perpetual annuity, also known as a perpetuity. A perpetuity is a stream of equal payments that goes on forever. This fits the nature of most preference shares very well. And luckily, there's a very simple formula to calculate the value of a perpetuity. Here it is. Price of preference shares is equal to annual dividend divided by investors' required rate of return. Let's pause and break that down. The annual dividend is the fixed amount the company promises to pay each year on the preference share. The required rate of return is the return the investor expects for putting their money into this kind of investment, based on the risk and opportunity cost. Let's work through an example to understand how to calculate the selling price of a preference share. Here's the question. A company issues preference shares that pay a 4% dividend on a par value of $50. An investor is expecting a 6% return from this type of investment. We are asked to calculate the selling price of the preference share. Let's solve it step by step. First, we calculate the annual dividend. The dividend is 4% of the par value. So we multiply 4% by $50, which gives us $2. That means the investor will receive $2 every year from this preference share. Next, we use the formula for valuing a preference share as a perpetuity. The formula is price equals annual dividend divided by the investor's required rate of return. Now we substitute the values into the formula. Price equals 2 divided by 0.06. When we do the math, 2 divided by 0.06 equals $33.33. So, the fair selling price of this preference share is $33.33. This tells us that if an investor requires a 6% return and the share pays $2 each year, then $33.33 is the maximum price they should pay for the share. And that's how we calculate the selling price of a preference share using the concept of a perpetuity. Now, let's take a moment to understand what this result really means. In our example, the company is offering a preference share that pays a 4% dividend based on a par value of $50. That works out to $2 per year. But the investor is not satisfied with a 4% return. They are expecting a 6% return for the level of risk they're taking. So here's the key idea. Because the fixed dividend is only $2 per year, and the investor wants a higher return, the only way to make the investment attractive is to lower the selling price. That's why the price dropped to $33.33. At that lower price, the investor is still receiving the same $2 dividend, but now it represents a 6% return on what they paid. This shows us a very important relationship in finance. When the required rate of return goes up, the price goes down. Or put another way, if an investment pays fixed income and the market demands a higher return, the only way to make it fair is to reduce the price. So in summary, even though the dividend stays the same at $2, the market adjusts the price so that the investor still gets their expected return. This is how supply and demand for returns influences the pricing of preference shares and other fixed income investments too. Now let us understand the cost of preference shares from a corporate finance perspective. To begin with, we must ask a basic but important question. What does cost mean here? In financial management, the cost of any source of finance refers to the return that investors expect, and therefore, the minimum return the company must provide to keep those investors satisfied. In other words, the cost of capital is the required rate of return for the providers of funds. So, when a company issues preference shares, the cost of preference capital is the rate of return that preference shareholders expect to earn on their investment. Let's take a step back and recall the formula for the price of a preference share. If you remember from earlier in the course, the price or market value of a preference share can be calculated using the formula. Price of preference share equals to dividend, divided by required rate of return. This equation assumes that preference shares pay a fixed dividend annually, and they are perpetual, meaning they do not have a maturity date. Now, from the company's point of view, this required rate of return for the investor becomes the cost of preference capital. So, let's look at the same formula and now rearrange it to solve for the cost. If we rearrange the equation, we get cost of preference shares equals to dividend divided by net proceeds from sale or market price. This formula gives us a straightforward way to calculate the cost of preference shares when they are irredeemable or perpetual in nature. Let's understand this step by step. Suppose a company issues a preference share with a fixed annual dividend of $10, and it sells the share to investors at a market price of $100. The investor expects to receive $10 each year forever in exchange for paying $100 today. This means the investor's required return is 10 divided by 100 equals 0.10 or 10%. From the investor's point of view, this is their expected return. But from the company's point of view, it is the cost they must pay every year to use the investor's money. So this 10% is also the cost of preference capital. Important note, net proceeds versus face value. It's important to understand that the price in the denominator is not always the face value of the share. It is the net proceeds, which means actual amount received by the company after deducting issuance costs, commissions, or discounts. This will be applicable when company issue new preference shares. For example, if the face value is $100, but the company receives only $95 after paying issuing costs, then preference share cost equals to 10 divided by 95, which is 10.53%. So the actual cost of preference capital is higher than it appears at first due to issuance expenses. Let's now summarize this clearly. When a company issues preference shares, the investors expect a fixed return in the form of dividends. This expected return by the investor becomes the cost of preference shares for the company. The formula to calculate this cost is cost of preference capital equals annual dividend divided by net proceeds from issue. This cost represents the minimum return the company must earn on the funds raised from preference shares in order to satisfy its investors. Now, here's an important clarification students must understand when we study the cost of preference shares. Unlike debt instruments, such as bonds or bank loans, the dividend paid on preference shares is not tax deductible. Let's break this down. When a company pays interest on bonds, it does so before calculating taxes. That means the interest expense reduces the company's taxable income, which ultimately reduces the tax it has to pay. This creates what's called a tax shield, a benefit that lowers the effective cost of borrowing. But in the case of preference shares, the dividend payment comes after tax. The company must first pay income tax on its profits, and only then can it pay dividends to preference shareholders. This means there is no tax advantage when a company uses preference shares as a source of financing. So what does this imply? It means that even if the nominal cost of preference shares looks similar to the cost of debt, the actual cost to the company is higher because they don't get that tax reduction benefit. Here's a simple way to remember it. Interest on debt reduces taxes, dividends on preference shares do not. That's why, when companies are deciding between different sources of capital, they often prefer debt over preference shares, especially if they are looking to minimize their after-tax financing cost. So always remember, while both preference shares and bonds may carry fixed payments, only debt offers the benefit of a tax shield. Now, let's explore the different types of preference shares in detail. These classifications are essential for understanding how companies offer tailored investment options to suit the needs of various investors. First, we have cumulative preference shares. These are preference shares where the dividend is cumulative in nature. This means if the company is unable to pay dividends in any given year, those unpaid dividends do not disappear. Instead, they are carried forward and must be paid in full in a future year before any dividends can be paid to equity shareholders. For example, if a cumulative preference shareholder is entitled to a 5% annual dividend and the company does not pay this in year 1, then in year 2, the company must pay both year 1 and year 2 dividends before paying anything to common shareholders. Next, we have non-cumulative preference shares. These do not carry forward unpaid dividends. If the board does not declare a dividend in a particular year, the shareholder loses the right to receive that dividend for that year. For example, if a company skips dividends in 2024 and the shares are non-cumulative, shareholders cannot claim 2024's dividend in 2025 or any other year. Third, we come to participating preference shares. These shares allow the holder to receive not only the fixed dividend, but also an additional share in the company's surplus profits after common shareholders have been paid a certain rate. For instance, a participating preference share might offer an 8% dividend, and if the company does well, the holder might get a portion of the remaining profits as an additional dividend. Fourth, non-participating preference shares. As the name suggests, these shares receive only the fixed dividend rate. Even if the company earns huge profits, the shareholder will not receive anything beyond the stated dividend rate. Next, convertible preference shares. These come with an option to convert the preference shares into equity shares at a predetermined ratio, either after a specific time or upon meeting certain conditions. For example, a shareholder may be allowed to convert one preference share into 2 equity shares after 5 years. Then, we have non-convertible preference shares. These remain preference shares throughout their lifetime. They cannot be converted into equity under any circumstances. Now, let's discuss redeemable preference shares. These can be bought back by the company after a fixed period, providing flexibility to manage capital and improve financial ratios. For instance, the company may issue redeemable shares with a redemption clause, stating that the shares will be repurchased after 10 years. Lastly, irredeemable preference shares. These have no maturity date and are not redeemable. They continue indefinitely unless the company is liquidated. Let's now look at a numerical example to understand the difference between cumulative and non-cumulative preference shares in action. Imagine that ABC Limited has issued 10,000 preference shares. Each share has a face value of $100 and the dividend rate is 10%. This means the company is expected to pay $10 per share as dividend every year. In year 1, the company makes no profit and therefore decides not to pay any dividends. In year 2, the company earns a good profit and is ready to pay dividends to shareholders. So how much dividend will be paid in year 2? Case 1, cumulative preference shares. Because the shares are cumulative, the dividend that was not paid in year 1 is not forgotten. It is carried forward. So in year 2, the company must pay $100,000 for year 1 plus $100,000 for year 2, which totals to $200,000 in dividends before any common shareholder gets a single dollar. Case 2, non-cumulative preference shares. In this case, the unpaid dividend from year 1 is not carried forward. So, the company only pays the current year's dividend. Just $100,000 for year 2. The missed dividend from year 1 is lost permanently. This example shows why cumulative preference shares are considered safer and more favorable to investors, especially in times of uncertain profits. Now let's look at the advantages and disadvantages of preference shares from the perspective of the company. This analysis helps us understand why a company might choose to issue preference shares and what trade-offs are involved. Advantages of issuing preference shares. First, issuing preference shares helps avoid dilution of ownership and control. Unlike equity shareholders, preference shareholders typically do not have voting rights. This means the existing owners or promoters can raise capital without losing control over decision-making in the company. Second, there is flexibility in dividend payments. Especially in the case of non-cumulative preference shares, if the company is having a bad financial year, it can skip dividend payments without any obligation to make them up later. This provides relief during low profit periods. Third, there is no legal obligation to pay dividends. Dividends on preference shares are not mandatory in the way interest payments on debt are. So if the company skips a dividend, it won't be pushed into default or bankruptcy proceedings. Fourth, preference shares are a good source of long-term capital. They allow the company to raise funds for large investments or expansion projects without placing pressure on short-term liquidity, since there's often no requirement to repay the capital or make regular payments immediately. Fifth, preference shares can strengthen the capital structure. Issuing preference shares adds to the equity base of the company, which improves leverage ratios and makes it easier to raise future debt on favorable terms. Finally, redeemable preference shares offer financial flexibility. The company can redeem or buy back these shares at a suitable time in the future, especially when it has surplus cash. Disadvantages of issuing preference shares. On the downside, preference shares are more expensive than debt. The dividend rate is often higher than the interest rate on loans, and unlike interest, dividends are not tax deductible. This means the effective cost to the company is higher. Another major drawback is related to cumulative preference shares. If dividends are skipped in a low-profit year, they accumulate and must be paid in the future, adding pressure to future cash flows. This can hurt the company's ability to invest or grow. No tax shield is available on dividends. Interest on loans reduces taxable income, but dividends do not. This means the company ends up paying more in taxes if it finances through preference shares instead of debt. In profitable years, fixed dividend payments limit flexibility. The company must pay the agreed-upon dividend to preference shareholders, even if it has much higher profits. That reduces how much can be reinvested or distributed to common shareholders. Issuing preference shares might send a negative signal to the market. Investors might think the company is unable to raise funds through cheaper equity or debt, which could affect investor confidence and stock prices. Lastly, redeeming preference shares requires careful planning. The company must ensure it has enough cash available at the time of redemption. This can strain liquidity if not planned properly. Let's take a quick pause here and test your understanding with a simple but powerful sentence. We're not solving a problem just yet. Instead, we'll break down the terms used in the question and understand why they're important. For CMA exam, the question will be like, a company issues $100 par value, 10% cumulative preferred shares. Now that you've completed this module on preference shares, this sentence should make perfect sense to you because it's packed with concepts we just learned. First, let's look at $100 par value. This is the face value of the preferred share. It's the amount on which the fixed dividend is calculated. Even if the shares are sold at a different price, the dividend is still based on this $100. Next, we see 10%. This refers to the dividend rate. That means every year, the shareholder is entitled to receive 10% of the par value as a dividend. Since the par is $100, that means the annual dividend is $10. But we're not solving that yet. Just keep in mind how dividend rates work. Finally, we see cumulative preferred shares. This tells us that if the company misses any dividends in a given year, those unpaid dividends will accumulate. And the company will have to pay those before it can pay anything to equity shareholders. So, in just one sentence, this question brings together par value, dividend rate, and the cumulative nature of preferred shares. If all of this makes sense to you now, you've clearly understood the key parts of preference shares, and you're ready to move on to calculation-based questions. Let's now wrap up this session by quickly revisiting the key concepts we covered in this episode on preference shares. First, we began by understanding the difference between preference shares and bonds. Bonds are debt instruments that come with a legal obligation to pay interest and repay the principal. In contrast, preference shares are part of the equity structure of a company. They offer a fixed dividend, but there's no repayment requirement and dividends are not legally enforceable. Second, we explored how preference shares differ from common or equity shares. Preference shareholders receive priority when it comes to dividend payments and capital return, but they generally do not have voting rights, unlike equity shareholders who have control but receive dividends only after all other obligations are met. Third, we looked at the selling price of a preference share. We used the formula, selling price equals dividend divided by required rate of return. This shows the value an investor places on the preference share based on the fixed dividend and the return they expect to earn. Fourth, we calculated the cost of preference shares from the company's perspective. By rearranging the formula, we saw that cost equals dividend divided by net proceeds from the issue. This cost represents the return the company must provide to investors. And importantly, we learned that there is no tax benefit on preference dividends, unlike debt, which offers a tax shield on interest payments. Fifth, we explored the different types of preference shares, especially the distinction between cumulative and non-cumulative preference shares. We discussed a numerical example and showed how missed dividends in cumulative shares must be paid in the future, while non-cumulative dividends do not carry forward. Sixth, we discussed the advantages of issuing preference shares, such as no dilution of control, flexibility in dividend payments, strengthening of the capital base. And finally, we looked at the disadvantages, including higher costs than debt, no tax shield, potential burden from accumulated unpaid dividends in cumulative shares. Thank you so much for watching this episode. I hope you now have a clear understanding of preference shares, including what they are, how they work, their types, their cost, and how they differ from bonds and common equity. But always remember, while these lessons are designed to help you understand the concepts deeply, your real learning happens when you practice. So please make sure to go through your question bank and read your textbooks. That's where you'll find additional examples, variations, and detailed explanations that reinforce everything you've learned here. And most importantly, practice as many questions as you can. That's what will give you the confidence to solve questions quickly and accurately in the actual CMA exam. Once again, thank you for being part of this session. Stay focused, stay consistent, and I'll see you in the next episode. Take care and happy learning.